All right, y'all. I am here. I am here. I am here. Technology is not letting me be great today. But I'm here. I'm here. I'm here. I'm live on YouTube. Let's do this. It's Monday again. I'm Confessions of a Black Female Investor. I'm back with another episode of What's in My Bag, Lunch Money Talks, breaking down the stock market today. And if you are here, if you can see me, just give me, yeah, I got my thumbs up. Somebody said it before I even needed to say it. So that's awesome. I'm going to give people a couple moments. I was supposed to be live on Facebook, but it seems like it wouldn't allow me to do both for some reason. So I'm just going to give people a minute to get over from Facebook. This technology stuff, it's a journey, but it's going to be good today. It's going to be worth it. Everything that I'm sharing today is going to be super helpful for you in your investing experience and getting you up to where you need to be. So take a minute. If you're new here, hit the like button, hit the subscribe button. You must be subscribed to ask a question. And I love questions. I love being able to share the information. I love being able to have conversations. So just make sure you hit that subscribe button. Make sure you hit that like and share. Hit all the buttons so all the people can see this and we can help as many as we can. So thank you for my remote technical assistant who is always here on Mondays and supporting me and letting me know when things are working. I appreciate you. All right, so we are going to get into this. I'm just going to give it another minute or so, and we're going to get there. We're going to get there. Thank you again for waiting. Coming over from Facebook, thank you. I don't know why it won't let me be great, but we are here today. It's Monday, Confessions of a Black Female Investor. So I'm going to get my information up here for y'all so y'all can see it, so you can learn from it, so you can take what you need to take from it and share it with everybody. All right. So today, your first 10,000 in the stock market, the secret to wealth. That's what we're talking about today. So all the passive income sources, stock market investing 101. So I'm going to start from the basics because I think that's where a lot of people need to start, because I think there's a lot of misconceptions about the market out there and how you invest and how you make money. So I thought it was incredibly important to start there today. So that's where we are starting today. Get your pen, get your paper, get your phone, whatever notes, whatever you use to take notes, make sure you have it ready with you. And let's do it. Okay, let's do it. So first off, I gotta say my disclaimer, because you know I'm always going to protect my coins over here. So the information provided here is for educational and informational purposes only. It should not be construed as financial advice or recommendations to buy, sell, or hold any securities or other investment. Any opinions, news, research, analysis, or other information contained in this communication is not provided as general marketary, is only provided as general marketary and does not constitute investment advice. So as always, please always do your own research. And I'm talking about from me, from anyone. Don't invest in anything you don't understand. And by the time you leave here, though, you're going to understand it and you're going to know why it's so important. So hit the like button if you haven't, hit the share button if you haven't, and don't forget to subscribe to the channel so that if you have a question, you can drop it in the chat. And as always, I always encourage kindness. I always encourage vulnerability here because we're all here to learn. We're all here to share information, whether you're a novice, a new investor, or whether you're a seasoned investor. I appreciate you being here. And I just want to make sure that we put that out there, that this is a safe space. The social worker in me has to always come out, but this is a safe space for you to ask questions and let's learn together. All right, so I want to give you a little bit of background about who I am, and I'm not going to spend a lot of time here, but I think it's incredibly important because I think, especially in the Black community, there's this image out there of what an investor looks like, right? There is this image, and most of the time, it's not a Black person, and in most of the cases, it's not a female, right? So It's, the image is this white male dominated industry. And that's entirely not what it is, right? So Black people are investing in the stock market. It's even more crucial than it's ever been for us. This wave that we are in when it comes to the tech industry, that's what we want to be a part of. Okay. And so most of us are consumers, and we've got to change that to now being investors. Okay. We have to start talking about equity and ownership. So I say all that to say has been my journey, but I want to share my small piece, the small piece of my journey, to let people know that it does not matter where you come from. You should be investing in the market, and you can invest in the market. Okay. So again, just a little bit about me. There's my cute family up there. And I have working parents. So I want to stress, I did not come from money. I did not come from a financial background. I did not come from conversations about the stock market or home ownership or building equity, building generational wealth. Those conversations weren't had. My parents did not know to have them. My aunts and uncles did not know to have them. So this is all information that I learned through life, through just tapping into other sources. Contrary financial knowledge. So not knowing, like, it wasn't even no financial knowledge. It was those things that we are taught that we have to unlearn. And what I talked about is just again, investing being for white people, investing being for people who already have money, and not understanding, how to use debt in a good way, how to leverage debt, all these things that, people say, oh, you don't want a credit card. No, if you know how to use your, leverage debt, then that's what you want to do. You want to use other people's money. You just want to be able to be buying assets that are providing you a return. Okay. And then this idea of the scarcity and abundance spectrum. So when I grew up, like, we had times where we were legit poor. Like, I'm talking mayonnaise sandwich poor. Okay. So I was on this spectrum of either we didn't have it or we did have it. And when we did have it, there was this abundance, right? And so it wasn't this idea of let's put some money aside and let it grow so we don't have to go back to the scarcity, so we don't have to do this cycle. It was like, no, now we want to buy the J's. Now we want to buy the clothes. Now we want to go on trips. There was no medium in between. And so, that was a big piece of my childhood, and how I learned money initially. And so I had to rewire some things. And then the other things I just want to add is that I'm a clinical social worker. So I said that before, the social worker in me is always going to come out. So I'm always have a focus on money mindset when I'm doing these, when I'm sending this message. But then the other piece is just that, people think that social workers can't make money. And I'm thankfully blessed in a job that I'm able to do well in, that I'm able to contribute to the stock market, that I'm able to save for my retirement. And I did this with a single income, right? I am not married. I am a homeowner, and I did these things. I started this investing journey by myself as a single person, and, hold accounts by myself as a single person. Now, my partnership allows me to contribute much more. I want to be very clear in that. But I started this as a single person with one income, and it's very, very, very manageable. And then the last thing is that I'm a late investor. I didn't start investing in my 20s. I didn't start investing into my 30s. Let me back up. I started investing on my own in my 30s. So I was investing with my employer, but I didn't really understand what I was doing. And so that's what I want to get you to do today. Like, even if you leave here and you say, you know what, I don't want to do an IRA, Tasha, I'm not ready. That is cool. I want to make sure you're maximizing your employer investment account at the very least to get the returns that you need, to get the growth that you need, to be worth the sacrifice that you're making now, and sustain and continue to make you money. All right. So hit the like button, hit the subscribe button. So if you have a question, and definitely share this. So, what's investing in the stock market? Again, let's get down to the basics. We're starting with the basics, and the basics is it's an exchange. That's all it is. It's an exchange in the same way that you go to the store and buy a carton of eggs. You give them money, they give you eggs. That's the same thing you're doing on the stock market, except you are buying pieces of ownership in a company. So when you invest in companies like Apple, Google, Microsoft, you now own a piece of that company. And that's what we want, because those companies are going to be around for a long time. And so we don't just want to invest in the products. I don't want you just walking around with AirPods and an iPhone. Okay. I want you owning Apple, and that this is the way that you do it. Okay. Secondly, it's mutually beneficial. Publicly traded companies need our money, right? The innovation and the products that they put out don't just happen. They need investors to come to put their capital in to be able to do more with their product. And in doing more with the product, obviously the product is more successful. And if you're a publicly traded company, that means your stock goes up. So that's what we want to be doing. We want to both be benefiting from this. Okay. And then lastly, it's how most people are already funding their retirement. So this is the thing that I think a lot of people miss out on. A lot of people don't realize that your 401k, 403b, TSB, it is not a savings account in the traditional sense, in that you are putting money there and that's the safest way to hold money. It's just there. No, okay? This is an investment account. So when you put that money in, whether you're doing and automate most people are doing, like an automated 5% or something like that, that goes into your retirement account. And then that money is then deployed into stocks or mutual funds, whatever pre-selected funds that your company has bought for you to be able to invest in. So I know a lot of people miss out on that piece. And so if you get this quarterly statement from your 401k, you may have gotten it, for example, say in January, and you were up because last year was great in the market. But then if you got it at quarter two, when April hit and we had a significant drawdown in the market, then you saw like a hit in your account. You're like, wait a minute, how did I go from having $40,000 to now having $28,000? Because that money is invested. Now, the great thing is if you left it in there, which you should have, then that 28 is probably back up to is surpassed 40 and is up to $60,000 now. So that's the one thing I want to make sure. I'm going to say that a lot probably, but like that's one of the first things I want to make sure that people understand is that your retirement account through your employer is not just a savings account, it's an investment account. Okay. So why does investing in the stock market matter though? Right. I'm not gonna, like, I can give you a whole bunch of stuff, but I'm gonna tell you exactly why it matters. And it's this one rule. Your money is always gonna work harder than you are. There's no ifs, ands, or buts about it. Because here's the thing, your money in the stock market is going to be working 24/7. Okay. You can't work 24/7. So anytime that you are making more money, that's time away from your family, that's time away from your goals, that's time away from your rest. Okay. So you are working. Whereas when you put money in the stock market, you are not working. Your money is doing the work. And that's why the term passive income comes up a lot. Okay. So just looking at this, why investing in the stock market matters. When you talk about money, okay, this is a picture that I love to show. So our time is always what we want to have on our side. But if you look at this over a 10-year period, your $12,100 investment grows to $19,384. So if you've got that in like a regular savings account at Chase, that $12,100 at the end of 10 years is probably going to be like $12,122. It's going to be nothing, right? For the time that they've spent investing your money and for the money that they've gotten return. But with a 10% return, which is I'll talk to you a little bit about how you achieve that later in the presentation. But this is how your $12,000. So you just got a free $7,200. $7,200 you got from being able to invest in the stock market, picking quality stocks, and just letting it sit there. Just lock that in. You didn't have to do anything. All right. So let's get into the best way to start. All right. So we're going to get you to that path to 10,000. The first one is your employer. So this is a non-negotiable. And I'm going to tell you there's a couple reasons why you have to be investing with your employer. And the biggest one is most employers are doing some type of agency matching. So whether that's dollar for dollar, whether that's a percentage, I invest with a thrift savings plan. So my employer matches my first 5%, dollar for dollar. So that means if I contribute $100, then they are going to match that 5% of that. So that's just free money that you are getting. So you always at least want to be contributing up to the agency match. So if they're matching 3%, you at least want to contribute 3% from your check. If they're matching 5, you at least want to do that. That's the primary thing. That's the first non-negotiable. Okay. The second thing is for the tax advantages. So this is what it's really all about when it comes to investing. We're trying to get money to hold on to it. And the best way to do that is looking at, are you investing with a traditional account, or are you investing with a Roth account? So a traditional account is going to give you your tax break on the front end. So say, for example, that you bring home, let's just say $1,500 every 2 weeks. Okay. You bring home, or you gross $1,500 every 2 weeks. If you are contributing through a traditional plan, once they take that 5% away, you're only going to be taxed on the remaining balance. So that remaining, $1,300 or $1,425 is what you'll be taxed at. So that's what's going to be taxed, not the full 1,500 if you're looking at a traditional. So you're getting that tax break in the front end. Now, when you withdraw in retirement, that money is going to be taxed. And at that point, you're getting taxed for your earnings and for your contributions, okay? Because you have not paid tax on that money. So that's one option. The other one is the Roth option. So you can contribute to a Roth and then your full balance is going to be taxed. But when you go to withdraw in retirement, that money is not taxed. That's your contributions and your earnings. Okay. So lock that in. I'm big team Roth. I have a hybrid approach that I use with my employee sponsored retirement plan. So with my TSP, I have, a percentage going to my traditional, and then I have a percentage going to my Roth. So that way I'm building both of them. And then, I have a strategy that I'm only going to take from my traditional in the smallest amount to keep me in the smallest tax bracket, for income. And then that other money, my Roth money that is not taxed, I'm going to pull that out as I need it and live off that. So that's why a big piece of why it's so important is the tax advantages that come with investing in the stock market. Income limits with your employer are going to be much higher. So a lot of people don't know this. I didn't know this, that the IRS sets limits on how much you can save for retirement, which is the craziest stuff I've ever heard in my life, but it is what it is, right? It's there is, and there's a reason for that. And we can, spend all day talking about that. But the reality is they've set these things up to be able to tax your money. And so they don't want you contributing a large portion of pre-tax income or Roth income and being able to not pay taxes on it later. But with all that being said, so if you have an individual retirement account, which I'll talk about in a little bit, an IRA is commonly called, you are subject to a limit, a single person of 7,000 per year is what they're saying that you can save. Now, your income limits with your employee sponsored retirement plan are $23,500. So you see the big difference here. You can save 23,500 if you're under 50 years old, or you can save 7,000. So you can totally, and you can save 7,000. You can do them both, but you see how much more you get to save on this end. Okay. And then just knowing your plan type. Like a lot of people don't even know, like, do I have a 401k? Do I have a 403b? Do I have a TSP? Make sure that you are aware of your plan type. So if you don't know that, once you once you leave here, go find that out because it's set up a little bit differently. And knowing how to navigate that is incredibly important. And then your last one. So this is non-negotiable number 2. And that's your investment options, knowing what you can invest in and what type of returns that account, that fund is getting. Because here's the thing, your employer is not your financial advisor, okay? They are not here to make the best decisions for your money. You have to have some type of understanding of what's going on. And I'm going to show you why it's so incredibly important on the next slide here. So you need to know whether you're investing in mutual funds, whether you're investing in stocks, whether you're investing in bonds, because a lot of people will lose money or have money growing in the market, but they've lost out on tens of hundreds of $1,000s by not knowing exactly where they're invested. All right, so these are 3 funds. Again, as I mentioned, I invest with the TSP. So these are 3 funds that, let me see if I can change this format because you guys might not be able to see everything the way I can see it. Maybe not. Okay, so these are 3 funds, and I'll just show you the I fund. The I fund is returning at 7.31%. Okay, so where my little picture is, I don't know if that's showing the same way for y'all, but it's 7.31%. So lock that in. And this is 3 of the funds that I have the option to invest in with my thrift savings plan. Now, if you don't know anything about math, if you don't know anything about returns, you can look at these numbers and see that if given the chance, I want 21%, right? I want my money to return at 21%, not 3.65% or not 7.31%. Okay. So if you know nothing else, you need to be looking at what you're invested in and seeing what type of returns it's giving year over year over year. Okay. So the S&P 500, which is this C fund, is down a little bit from when I actually did this presentation. I think it's about 12%, 12 to 14% year to date. But again, nonetheless, much better than 3.65 and better than 7.31. And definitely much better than anything that you're getting in a savings account. Even a high yield savings account is not going to give you returns like this. So, there are people, I hear horror stories about people are like, my mom worked for 40 years and she only, ended up leaving her job with $60,000. No disrespect, but mom didn't know what she was doing because the stock market has consistently performed and S&P 500 has consistently returned at least 10%. So over year. So making sure that you know exactly where your money is invested is incredibly important. Hit that like button and hit that subscribe button if you have it. So this is a chart that just breaks it down a little bit more. And you see year over year, over 10 years, that $10,000 at a 3.65% return, right? You barely have over $10,000. You got about $15,000. Look what that 29 or 21% return, over $60,000. That is the difference that we're making here, okay? You're looking at leaving $30,000, $40,000 on the table if you don't know where you're invested. So remember, it's the same $10,000 for you. You put in $10,000, but you determine how that money is going to do in the market by what you're invested in. So, is common information, being able to Google what your funds are doing or going to pull your returns. Look at that information because you don't want to have 10, 20, 30, 40, 50 obviously most of us are going to work, 30, 40 years. So we're going to be investing hundreds of thousands of dollars with our employer. You don't want that sitting somewhere that's getting less than a high yield savings account. So please, please, please lock that one in. All right. So individual investings accounts. So that's the other option. So we're getting away from our employer now and we're going to investing on our own. This is what I love because this is what I have control of, right? These are the companies that I can specifically say, I want to invest in Google. I want to invest in Microsoft. I'm going to go out and buy a share of that company. You can't do that going through your employer because they've, again, as I mentioned, they've got preset packages of what you have to invest in. But this investing on your own, that's how you get to the money. That's how you get to the really, really significant growth in your account. So when you're picking an account, non-negotiable number 3, you always want to consider tax liabilities. So I talked about the Roth and the traditional option, but keeping in mind when you're looking at a taxable brokerage, you want to make sure that's at least the second account you choose, okay? Because there's no tax advantage that comes with that. So first, you've got your IRAs, your individual retirement accounts. So these are tax advantage accounts designated to help you save for retirement. Again, it's the same strategy. The money is invested, but it is a type of savings tool. IRAs, traditional and Roth, operate the same exact way as they would for your employer. The only difference being that you have those lower limits of $7,000, and then you can't access that money until you're at least 59 and a half. Okay. So this is going to be truly for your retirement. And this is, again, the Roth is the best option. And you have to think about it. Why are they only letting me put $7,000 in this account, right? Why is this limit so low? Because the potential you have to make in this account and be able to withdraw it tax-free is insane. So keep that in mind. If you don't have any other account on your own, you want to make sure that you're getting a Roth IRA. The taxable brokerage. So the taxable brokerage is another option. Once you've maxed out your Roth IRA, your taxable brokerage does not come with income requirements, okay? Does not come with a restriction. So you can contribute $20,000, $30,000, $40,000 in that account. There is no tax advantage of it though. So if you pull out money from this, it's going to be taxed as regular income, just like your paycheck is. So that's why I say make sure that you're looking at your IRAs and you're maxing those first, because then you're going to get that traditional tax benefit or that on the front end or that Roth tax benefit on the back end. Kids accounts. So kids accounts, this is one of the best ways to be able to build wealth for your kids is opening up them an account, either a custodial Roth if they have some type of job that they are getting paid for. And it can be anything. It can be cleaning their room. It can literally be cleaning the room. The IRS does not care where the money came from for kids as long as it's already been taxed. So if you say your kid, you give them an allowance of $25 every week for cleaning their room, that can go into a custodial Roth account because that money has already been taxed as a part of your paycheck. And then that money can grow tax-free for them. So custodial Roths, youth accounts. So, if you've got a teenager that's working, they've also got 529 plans that can be utilized for education expenses. So those are some of the common kids investment accounts that you can look into. And then the last one's going to be our specialty investments accounts. So those are going to be like HSAs, health savings accounts. So if you have a high deductible plan, you can get an HSA and max that out. You obviously invest the money that's in that account, so you have to use additional money to pay for expenses. But HSAs are triple tax advantage. So they're such an underrated tool if you qualify with that high deductible plan, because you get a tax break on the front end, you get a tax break when you use it for medical expenses, and then you get tax-free growth, okay? So that is a triple threat when it comes to your tax liabilities. You always want to make sure that you're considering that tax liability. And understand that your tax liabilities may change, right? Based on your income, based on your marital status, based on where you live. So, once you pick a strategy, you're not married to it for life. You just want to make sure that it fits your best situation, provides you with the best outcomes, and lowers your risk overall when it comes to investing your money. So, number three, always consider your tax liabilities. So, how much money do I need to start investing? That's the question everybody asks. Everybody wants to know because they think I don't have enough. I need $1,000. I need $500. No, you don't need any of that. You don't need any of that. An account is free to open. Okay. An account is free to open. So I'm talking about like not even $1 that some banks use. It's free to open a brokerage account. I'll talk a little bit about brokerages in a little bit, but it's free to open the account. Fidelity, Vanguard, Schwab, some of the other apps that allow investing: Robinhood, Tasty Trade, Webull, Moomoo. Those are great for new investors. If you're not doing, actual trading and you're really just wanting to look at the apps and see how to navigate them, those are great options for new investors. But when it comes to your retirement, when it comes to, large sums of money, I definitely recommend one of the well-known brokerages such as Fidelity, Schwab, or Vanguard. Dollar cost averaging. So how are we funding? We are just using dollar cost averaging, which is one of my favorite strategies. Dollar cost averaging means I am putting the same amount of money in this account regardless of what the market is doing. So you can dollar cost average with $5. I literally set up an account for some of my clients to start with $5 because investing is not just about the act of investing. It's about building the habit. It's about getting the mind right to be like, look, I got to set this aside and I got to be able to contribute to my future. So please understand that you don't need a lot of money. Dollar cost averaging, you put that $5 in. When that $5 buys the stock, so say this stock is $1 today, okay? When I put in my $5, if the stock is $1, then I'm going to get 5 shares, okay? Now, because I'm dollar cost averaging, say the stock goes up to $2.50 a month later. That's great. I made $1.50, but also now when I invest my $5 again, I'm only going to be able to buy 2 shares. So that's the great thing about dollar cost averaging. It averages out how much you are spending to be able to buy those shares. So dollar cost averaging, one of my favorite strategies, what all investors really should be doing, because again, it keeps you in the habit of investing in the stock market. Fractional shares. So you can always get into the market with fractional shares, meaning you don't have to buy a whole share of Apple, right? I think Apple's currently trading at, I don't know, I think it was like 217, 219. The last time I looked, let's see what it is. So, all right, Apple is currently trading at $249. Okay. So a lot of people think, well, I don't have $249. That's okay. You can put $20. You can get $20, put that into your, invest that into the market, and then you get a fraction of that share. Okay. So the great thing about a fraction of that share is, guess what? That means you get a fraction of the dividend. So you get a fraction of the growth. So even though you may not have enough to build another share, you continue to do that until those shares start, or till those fractional shares add up to that full share. You will get there. I promise you will get there. It's just about being consistent and being focused and maintaining your strategy. As long as you contribute that $20, is going to take you a little bit longer, but I promise you, once you see that growth, you're like, let me find $30 to put in. Let me find $50, because you'll see that your $20 turned into $40, $50, $60. And so you start thinking of it on a larger scale, right? So like, well, if 20 turned into 40, then what's 40 going to turn into? And so that's the power of investing, that compounding. Lastly is passive income. So I just talked about that a little bit, like how you are getting this free money when it comes to the stock market. Dividend reinvestment plans. So those are drips, right? So when you talk about dividends are something that the company says, hey, Thanks for being an owner in our company. Thanks for believing in us. Here is 10 cents for every share that you own. So, right? So they give you that 10 cents and then you invest it back into the company. And guess what? You just keep investing it back. And eventually you're going to have enough to buy a new share. When you buy that new share, it's going to come with more dividends. And that process just repeats itself in the background. You're not doing anything. All in all, you're just getting more and more money. Okay. Because remember, it's per share. So if I have something that is, I'm getting a dividend of 10 cents and I have 10 shares, then I just got $1. And say that stock is trading at, $25 or $20, we'll do a nice round number, then I just got 10% of that share. And that's going to continue to add up till I have that full share. And then you have your gains, your capital appreciation. This is what we're really all in this for, right? Buying the stock and holding the stock until it goes up in value. Buying the stock at $100 and we are holding it. We're holding it for 5 years, 10 years, 15 years to when it goes up to, now it's trading at $250. Guess what? I bought it at $100. I can now go sell it for $150. Again, that's what we're talking about with that exchange. We are just exchanging our money for their asset, and then we're going to give it back to you once it's worth more. And that's why we're holding these for the long term. So, got 20 minutes. Have you started my $20 challenge? So if you have not, go over to Instagram, confessions_Black Femme Investor, or Facebook, Confessions of a Black Female Investor. It is pinned. I tell you everything from beginning to end, including 2 funds that you can invest in to get growth. Okay. So you'll earn shares of company like Apple, Nvidia, Amazon, Meta, all of that for just $20. And people don't realize that that's all it takes to be able to invest in some of these companies. So check that $20 challenge out. Start with $20. Start building the habit. That's all we want you to do, is just start building that habit. So what are some common investment options, right? So when you get there, when you get this brokerage account, it can be daunting. You're like, what do I invest in? So I'm going to give you some options. The first thing is index funds. So as a new investor, I want you investing in something that's going to give you automatic diversification, which is going to lower your risk. Okay. So index funds are, think of like the picture that I have up here, right? It's this smorgasbord. It's this buffet. You get a little bit of everything, but it's packaged at one price. So the same way you go to a buffet and you can get chicken and spaghetti and ice cream, that's what an index fund gives you. So it gives you access to these companies that if one of them isn't doing well, so if the chicken's not good on the buffet, then guess what? The spaghetti's still good, the ice cream's still good. You're going to be able to find something. That's the same thing that's happening with the stock market in an index fund, okay? If Apple is not doing well, I guarantee you, then probably Home Depot is doing well, Costco's doing well, Netflix is doing well. So when it has that one stock pulling it down, it has other stocks pushing it up. So you don't have a huge risk. Your money is not at a huge risk of being lost if you have that balance in your portfolio. And so index funds, either through an ETF, which is a stock, or which is a fund that trades just like a stock, or a mutual fund that trades a little bit differently and has some different tax implications. But both of them give you that same diversification. Next are stocks and shares. So that's going to be your individual Apple's, Amazon's, Google. Those are just individual companies that, again, you could potentially get more growth, but there's more risk associated with those because it's just one company, right? So again, it's just like going out to a restaurant, right? If you go and all you bought was a cheeseburger, if that cheeseburger is whack, that's all you bought, then it's gonna tank, right? You're not happy now because you only had that one thing to eat. But that's why you want to look at index funds for new investors. Now, when you talk about really getting that growth, then certainly you want to have stocks and shares, those individual companies, but it's how you balance your portfolio. So having a really good foundation of those index funds then allows you to say, okay, well, I can take some risk now because you know what? I've got all these other companies doing well. So if I go buy some shares of Apple, if I go get that cheeseburger and it's not good, that's all right. I got all these other things over here doing well. So keeping that in mind. The next is bonds. So I won't spend a lot of time here because bonds is not where you want your money right now. I'll just say that the returns aren't great. There's too much happening in the tech industry. There's too much growth in the tech industry. Bonds are a very safe and conservative way. So let me actually back up. So if you are nearing retirement or in retirement, then a bonds would potentially be somewhere where you can park your money because you're not going to see a lot of growth, but that's okay because you're not going to see a lot of loss. And so when you're nearing retirement, you want stability. You want to be able to know that your money is safe. Where if you're in your 20s, 30s, 40s, you got some time, you likely want bigger gains. You want to be able to make some money. And so bonds are just operate a little bit differently than stocks in that bonds you are saying, I'm going to invest in you, but you are not going to give me ownership. You're just going to give me my investment back with some interest on top of that. So think of bonds as kind of like the reverse of what happens with the credit card, right? So when you get a credit card, the company is saying, hey, we're going to let you use this money, but you're going to pay it back with interest unless you pay it at the end of every month. And please pay it at the end of every month because we ain't giving away no money. But I digress. So we're going to give you this money and then you're going to pay us back with interest. Okay. With the bond, you're saying, I'm going to give this government, whether a government entity or a private company, I'm going to give y'all this money the same way that I would do with the stock. But instead of giving me ownership, you're just going to pay me back my money with some interest. So think about bonds just like that. And then REITs. REITs are a common one. They're really attractive to new investors. I kind of got a love and hate relationship with REITs, but they are a tool, and it's a way for you to invest in real estate. It's a way for you to invest in real estate without having the actual structural property to have to deal with tenants, to have to deal with maintenance requests, taxes, and things like that. So, like companies like the Simon Group, who own a lot of malls, you can actually invest through them to, have get returns from their stock through REITs. So, again, I could spend a lot of time talking about REITs because they look attractive to new investors because they tend to have higher dividend yields, but they can be tricky. So, if it is an approach you're looking, just make sure you do your own research when you're thinking about investing in REITs. So the fourth non-negotiable, the index fund, the S&P 500. So this is what all new beginning investors want to consider as their first stock. And then I would even venture to say as a large portion of your portfolio is the S&P, a stock that mimics the S&P 500. So I think of the S&P 500 is the ultimate index, and this is the thing that you want. So you see, I have all the foods there because who doesn't love food? But it helps lock in for you. You see how diverse it is. So the S&P 500 is the top 500. I think it's up to like 509 companies right now. It's the top 500 large market cap companies. So in layman's terms, it's the best companies in the world. In the US, it's the best companies in the US. Okay. These are proven successful companies. Again, you probably know them. You could probably, actually list a good portion of these if you really thought about it, because they're the companies that we know and use every day. They're the Netflixes, they're the Home Depots, they're Costco, they're Apple, they're Coca-Cola, they're Google, Microsoft. All of companies that we use every day, those are in the S&P 500. So you have automatic diversification that I talked about. You have strong returns. Again, I talked about it, averaging 10%, but it's much higher because of the tech industry right now. You can buy with index funds, either ETFs or mutual funds that are going to have low cost, but they're also going to come with that low risk. They're easy to access. It's a passive strategy where you're literally buying and holding. You're buying and holding. You're buying and you're just stacking those assets. And if you get the right funds, then you're going to be getting those dividends, which can reinvest back in, and then you're able to again continue to buy more assets, which is compounding. So the S&P 500, all right, if you don't lock in anything else, lock in that. You want to invest in something like the S&P ETF that tracks the S&P 500. So VOO, Vanguard's version, IVV, BlackRock's version, SPY. These are all funds that track the S&P 500 that are going to give you automatic diversification that you can just hold on to, that you can continue to acquire shares of that and get growth over time. All right. The S&P 500, I'm just going to leave that there for a minute because the S&P 500 10, 20 years ago, initial investments in that and continuing to do that over time will easily make you a millionaire. Like easily. I'm not even playing. Like you don't even have to do anything else but continue to just invest in an ETF that tracks the S&P 500. Now, can you get bigger gains doing other things? Absolutely. But if you want to get some stable growth that's going to give you consistent growth, build that wealth foundation, this is what you need. All right. Where we at now? So the road to 10,000, how do you get there? How do you start, Tasha? And I'm going to tell you, I'm going to keep it real. You don't need a lot of money to invest, but if you want to start that $10,000 journey, this is what you got to do. You got to get your hands on $1,000. There are no ifs, ands, or buts about it. You have to get your hands on $1,000 because that is all we're doing is starting the habit. I need you to start disciplining your mind to say, okay, I'm saving for a goal. And once I get that goal, then I can do whatever else needs to be done. But you have to be willing to make sure that you can get your hands on $1,000. Okay. So you get your hands on $1,000, you open your brokerage account, and then you invest in an ETF that tracks the S&P 500. You're going to contribute $225 a month over the next 3 years. Now, I know that seems like a lot of money and it may seem like longer than you want, but I want you to just take a minute and think about, have you saved $10,000? And I'm here to tell you that saving $10,000 takes a lot longer than you would had you invested to make that $10,000. So this is a hell of a shortcut to get you to where you need to go. Okay. So I know it seems daunting, but I'm telling you, you absolutely can do it. It's about the discipline. Okay. It's about what are you going to cut out now to be able to have your money working for you at all times, because that's the way you make money in the stock market. We are buying back our time. So you're going to invest that over 3 years. And that's just a small fraction of it. That 10 years, or excuse me, that 3 years to get that $10,000 is just the beginning on what you can make if you stay consistent in that investing. All right. So 3 years, I think that's the other thing, when it comes to investing in the stock market, we're looking at a buy and hold strategy. Okay. We're dollar cost averaging anyways with our 401ks. Why not do the same thing on our own? So how do I get started? What do I do? Tasha, you've given me all this information. What do I do? So 3 things that you can do. One of the things that I do with my clients is an account setup. So I have clients that say, you know what, Tasha, I know I need to start this, or I'm not good with money. I know I need to start this for my kid. This is what I want to do. I want to start this account and I want to make sure that I'm just being consistent in it. So I don't even know really what I'm doing, but I just know I need to do this. So when they do that, sorry, y'all. So when they come to me and say that, I'm like, all right, cool. I got you. Let's do this. Let's set you up an account. Let's automate everything so you don't have to worry about anything. We automate it. We get it set up and then boom, your account's set up and you're absolutely done. You never have to look at that account again. I have clients that literally they look at their account one because I make them and say, hey, it's been a year. At least look at it and make sure everything is still good. See how much money you're earning. See how much growth you have. And they're like, oh, okay, yeah, had no idea. But it's so low maintenance after we set everything up that you just get to sit back and watch your money grow. Okay. The other thing is a live one-on-one investing course. So I do live one-on-one trainings. It's not a course that, I sell that's, duplicated and it's not set for you. It's me and you. We're sitting here and we're going through everything. Actually, we're going through everything. So I'm talking about developing investing strategy, talking about the best ETF, determining your risk level, identifying market sectors, breaking down the stock market, searching tickers and building watch lists. Everything that you need to do to be able to move on your own. If you're ready for that, then the live one-on-one training session is the best thing for you. Okay. So I highly, highly recommend that if you are ready to take that next step. And then the next thing is a strategy session. So some people just don't know where they're sitting. They're like, I think I'm ready, but like I probably need to clear some debt, and I'm still trying to work on this, and I'm still trying to work on that. Book a strategy session with me so we can look at exactly, if we want to focus on one goal or if we want to look at your whole picture of your financial situation and see, a lot of people just need help finding that money. They're like, I know I'm not making the best decisions with my money, but let me figure out how to find it. I can help you do that to say, okay, here's $20 here, here's $30 here. Let's put that together, make 50 and go ahead and automate that to the market. Okay. So financial planning, budget, retirement options, looking at getting you ready to invest, because I understand that everybody might not be ready, but sometimes you just need to sit down with somebody and be like, what am I doing? What am I out here doing? I don't know what I'm doing, so I need some help. And that's one of the things that I love doing, to be honest, because it's a bit of a puzzle for me to help people find that money. And then the last thing is my ebook. So if you don't know where you fit in yet and you are still trying to figure out, like, hey, I don't know, Tasha. I don't know if investing is right for me. I don't know if I'm the person that's supposed to be doing this. I don't know. Read the book. Read the book. This is a book that I wrote especially to Black women, because again, it was the book that I needed 10, 20 years ago. No one was talking to me about this. I was going to work every day, having a great government job. And I was one of those people that was in a G fund and I was getting 3% on my money year after year until someone sat down with me and said, what are you doing? You're no, that's not going to work for you. You're essentially losing money because you could have that money in a high yield savings account. So things like that, just those concepts that I wasn't aware of, or terminology that I didn't have, like, or just my mindset, like all this stuff seems so overwhelming. And that's why I put it all in this book, to break down everything, to help you with a subscription tracker. There's some journaling involved, addressing your money mindset, all the things that you need to put in motion to help you become a better investor. Here it is right here. So those are the options on if you're looking for some more help. And I want to be very transparent. It might not be the best sales strategy, but this is just like who I am. Is the information is out there, right? The information is out there. But if you are looking for some more help, right? If you want to have someone working with you, I'm willing to be that person. So final tips and takeaways. Do this, y'all. Don't wait on it. The sooner you start, the less you have to invest to be able to make more money. Listen to what I say. I'm gonna say it again for the people in the back. The sooner you start, the less you have to start with to make more money. Because I'm here to tell you, I'm here to tell you that when you become 50, become 52, become 55, and you start looking at retirement and you start really diving into your 401ks, you're going to say, damn, I wish I started this 20 years ago. When you start looking at your IRA, I guarantee you, you're going to say that. So what I need you to do is start now, okay? If you don't even fully understand, trust the process. Trust the process. It's going to get you to where you need to be, and you are going to be able to make money that you had no idea. Like my account are numbers that I never thought I would see. Like, this little brown girl did not think that I would ever have access to the money that I have access to. And I got that through investing. I truly did. And I wouldn't lie to you. So I want people to understand how important this is and how necessary it is to trying to grow your wealth and be able to access different types of things, different types of assets, and being able to buy your time back. So we're not at these jobs 10, 12 hours a day, being able to have your money work for you. All right, I'm back. I'm down off my soapbox. Prioritize. So you're going to always prioritize investing with your employer, and then always prioritize utilizing tax advantage accounts. Okay. Develop a strategy, diversify, index funds. This ain't hard, y'all. I know they try to make it seem like it's hard, and I think that's by design, and they try to make it seem like it's not for you, but it is. It absolutely is, and it's necessary. You just have to be consistent. The information is out there. The support is out there. Once you become my client, you're always my client. So you can hit me up and be like, Tasha, I heard about this, I saw this, whatever. Like, I'm here to be a support because I had to navigate this on my own. And so I want to help people feel motivated to navigate this. And lastly, patience, because we're doing it with our 401ks, y'all. We're going to work every day and we're contributing, and we're not trying to rush that process. So we don't have to rush the process with our IRAs, with our taxable brokerage, with any of that. Okay. Just be patient, and that money is going to grow. It's going to grow, and you're going to see, oh my gosh, how did my 10,000 turn into 18,000? How did it then turn into 24,000? How did it just keeps growing. So be patient, be consistent, dollar cost average, dedicate yourself to the process. You will get to the other side, and it will be worth it. It will totally be worth it. So thank you. If you are here from Facebook, if you're here from Instagram, I'm here every Mondays. What's in my bag? My YouTube, Confessions of a Black Female Investor. If you have an email, if you have a question, I'm happy to answer any questions you have right now. But if not, feel free to email me. Any questions for anybody? All right, y'all. Thank you again for tuning in. Definitely hit that subscribe button if you have it. Shoot me a DM, shoot me a message if you have any questions. And let's go build some wealth. Like, we are here. This is the greatest time. This is the greatest time to be able to build wealth. Again, what stocks are doing right now. I don't know if you see me, look down at my phone a couple of times because I'm just getting alerts after alerts about stock prices. So please, I implore you, talk to your mothers, talk to your fathers, your sisters, your cousins. This is what we don't want to miss out on. And this is how we truly build wealth. Okay. You don't need to be rich. You don't need to be white. You need to be consistent. You need to demonstrate that you are willing to be patient, and you will get there. All right. Thank y'all for tuning in. I really, really appreciate each of you. Hit the subscribe button if you haven't, and I'll be here next Monday.